Selling an appreciated commercial property triggers a specific sequence of tax liabilities. Upon closing, the seller's equity is subjected to layers of taxation that can reduce the capital available for reinvestment by 30 to 40. If the money lands in a personal bank account, the tax liability is triggered. To satisfy this rule, the investor must engage a qualified intermediary, or QI. This legally mandated third party holds the sale capital in a secure escrow account and transfers it directly to the seller of the replacement property. That replacement property must be like kind. While many assume this requires an identical property type, the IRS definition of like kind simply requires exchanging investment real estate for other investment real estate. Under these guidelines, an investor can exchange a high-maintenance $3 million commercial building for a $4 million portfolio of passive single-family rental homes. While the QI and the like kind definitions form the foundation, successfully completing a 1031 exchange depends on adhering to specific mathematical and chronological formulas. Achieving 100% tax deferral requires the math to balance. First, the replacement property must be of equal or greater value than the relinquished property sold. Second, the investor must also carry over an equal or greater amount of mortgage liability into the new property. Failing either side of this equation creates boot. This is the technical term for any unreinvested cash or any reduction in mortgage liability remaining after the exchange is completed. This diagram illustrates the consequence of that imbalance. If you sell a $3 million property but only purchase $2.8 million in replacement assets, the leftover $200,000 is classified as boot. Every dollar of boot is taxable. Preserving the tax shield requires engineering perfect equilibrium in both equity and debt. Two uncompromising deadlines govern the exchange. The clock is triggered on day 0, the exact day the sale of the relinquished property closes. From that date, the investor has 45 calendar days to complete the identification window, officially nominating target replacement properties in writing to the qualified intermediary. The second deadline is the 180-day exchange period to finalize the purchase. These periods run concurrently. The 45-day window sits entirely inside the absolute 180-day limit. These represent strict calendar days. The IRS does not grant extensions for weekends, banking holidays, or market delays. This rigidity leads to the April 15th tax return trap. If a tax filing date arrives before the 180-day clock expires, the exchange period is terminated the moment the return is filed. To prevent this, an investor must proactively file for a tax extension to preserve the full 180-day exchange window. Failing to respect the concurrent nature of this timeline often triggers the tax liabilities the investor intended to defer. Inside the 45-day window, the IRS applies specific mathematical constraints. Investors must select target properties using one of 3 identification formulas. Under the standard 3 property rule, an investor can identify up to 3 potential replacement properties, regardless of their total combined market value. To identify more properties, the investor must use the 200% rule. This allows an unlimited number of nominations, provided their combined value does not exceed 200% of the original sale price. The final option is the 95% rule, a formula typically utilized for high-value institutional portfolios. This rule allows for an unlimited amount of identified value. However, if the investor fails to close on at least 95% of the value on that list, the entire 1031 exchange is disqualified. These strict formulas force investors to make binding decisions within 45 days, creating significant pressure when viable real estate inventory is scarce. This creates a central tension. What happens if the 45-day clock is ticking, but there is no viable like-kind real estate available on the open market? One solution is the Delaware Statutory Trust, or DST. A DST is a legally recognized entity that allows multiple investors to hold fractional interests in institutional-grade real estate assets. IRS Revenue Ruling 2004-86 clarifies that acquiring a fractional ownership interest in a DST qualifies as a like-kind real estate replacement under Section 1031. As shown here, DSTs contain institutional-grade properties. Financing and due diligence are pre-arranged by a sponsor, who passively manages the asset for the investors. Because the ownership is fractional, DST sponsors can match the exact equity and debt amounts an investor needs, which can eliminate accidental boot. This makes the DST a viable backup plan. Investors can include a DST on their 45-day identification list to ensure their capital is placed if a primary target acquisition fails. Utilizing a DST provides a predictable, engineered alternative to a high-risk property search. Zooming out reveals how the 1031 exchange operates as a lifetime wealth strategy. The swap till you drop philosophy involves executing sequential 1031 exchanges, trading into larger assets, and compounding real estate wealth tax-deferred over decades. This raises the question of what happens to the accumulated deferred capital gains and depreciation recapture taxes upon the investor's death. The answer is found in the step-up in basis. This provision adjusts the tax value of an inherited asset to its current fair market value, rather than its original purchase price. As this chart demonstrates, heirs inherit the portfolio at its current market value. The accumulated tax liabilities are effectively erased. The 1031 exchange allows for compounding wealth growth. It offers significant capital velocity for